Good day, class. This is our 8th week of our lessons for our subject, Business Finance. Last week, we have discussed about the loan amortization and its computation using the mathematical concepts and the present value tables. Today, we will discuss about the finance and investment problems while we are using the computation by mathematical concepts and tools. So dito sa screen na nakikita ninyo, ano ang pagkakaintindi nyo dito sa graph base sa inyong pagkakaunawa? Ang sinasabi ng graph ay it is a risk-return trade-off. Ano ba ang ibig sabihin niyan? Pansinin niyo na merong arrow pataas, merong pakanan, and then meron ding diagonal arrow pataas din. Ano ba ang pagkakaintindi niyo dito sa graph na ito? This shows that the higher risk is associated with greater probability of higher return and lower risk with a greater probability of smaller return. This trade-off which an investor faces between risk and return while considering the investment decision is called the risk-return trade-off. Kung gusto ninyong mag-invest for something, we know that you are taking a risk. Kapag ang gusto mo ay yung return ay mas malaki, mas mataas ang risk niyan. Ano yung risk doon? Mas mataas yung risk na hindi ka talaga kumita ng ganun kalaki. Kapag naman yung risk ay mas mababa, para doon sa return naman na inaasam-asam mo ay mas mababa rin. So, ganyan yung risk-return trade-off. Tingnan natin ang istorya muna ni Jack and the Beanstalk. Kung inyong naaalala ang kwentong ito, may kapupulutan pala tayong aral dito in relation to our subject, business finance, at sa particular na topic na ito. Ano ba yung kwento ng Jack and the Beanstalk? Si Jack ay, mahirap sila. Meron siyang cow, no? Meron silang pag-aaring cow or baka. Dahil hindi masyadong nakapag-produce ng gatas yung baka, ang sabi ng kanyang mother, idalhin ito sa palengke, i-trade off, tapos dinala ni Jack yung cow doon sa market. Pero may nakita siyang isang tao na nag-offer sa kanya na ipagpalit yung cow niya doon sa beans. Ang sabi naman ng tao, yung beans na yun ay magic. Nainganyo si Jack. So, pinagpalit niya ngayon yung kanyang baka doon sa beans. Pag uwi niya, nagalit ang kanyang mother. At itinapon yung beans doon sa bintana at si Jack ay pinatulog na hindi kumakain. Kinaumagahan, nakita ni Jack yung beans ay tumubo. Yung pagkakatubo niya umabot hanggang langit. Dahil sa curiosity, inakyat ni Jack at doon may nakita siyang kalsada, tinahak niya yung kalsada na yon at nakarating siya doon sa giant castle. Doon sa giant castle na yon, meron din mga giant women, tapos humingi siya ng pagkain at noong paparating na yung asawang higante rin na kumakain ng tao, itinago siya. And then, siya ay nakatakas, dala-dala ang manok na nangingitlog ng gold. At saka, dinala niya rin yung gold harp. So, the last time he traveled up the beanstalk, the giant husband saw Jack as he is running out of the house with the harp and chases after him. So, ang ginawa ni Jack ay pinutol yung beanstalk habang siya ay hinahabol at yung higante ay nahulog at namatay. So base dito sa maikling istoryang ito na pambata, Ano ba yung pwede nating matutunan? Sagutin natin ang mga tanong na ito. In the story, what was the possession of Jack he traded in? Anong sagot dito? Yung baka. What products they gave in return? Ito yung ipinagpalit na niya, yung baka niya doon sa dala-dala ng isang stranger. Ano yon? Yung beans. Pangatlong tanong, was the trading good for Jack? Why? Dito, kayo ang makakasagot. Ano ba ang tingin ninyong sagot dito? Nakabuti ba yung pagkaka-trade in ng cow doon sa beans? O hindi? If you are Jack, will you also take the risk to exchanging your family cow for a magic beans? Why or why not? Kagaya ng istoryang ito ay ang mga desisyon na kinakailangan natin para sa capital budgeting. Ano ba ang capital budgeting? This is the process of evaluating and selecting long-term investments that are consistent with the firm's goal of maximizing owner's wealth. Ibig sabihin nito, malaking pagkakagastusan ito kung pag-uusapan yung long-term na goal ng isang kumpanya. Ano ba ang mga examples ng capital expenditure? Ito yan. Expand or enter into a new line of business. Magbabago ka ng linya mo sa pagnenegosyo or babaguhin mo yung negosyo mo. Replace or renew fixed assets. Halimbawa ng fixed assets mo, yung building mo. Papalitan mo na si building mo. Babaguhin. Construct new premises. Construction kasi malaking gastos yan. No? Pangapat, opening a new branch. Siyempre, pag nag-open ka ng panibagong branch, ang laking gastos niyan, ang laking cash out ang kinakailangan mo dyan na paglaanan ng funding. Acquisition of machineries and equipment. Ang mga machineries and equipment ay hindi basta-basta ang presyo. So, malalaking amount ang involved dito. Yan ang examples ng capital expenditure. Now, steps in capital budgeting, ito ang mga dapat nating tandaan bago tayo mag-decide ng isang malaking pagkakagastusan in relation to capital expenditure. The first one is investment proposal. Proposals for capital expenditure come from different levels within a business organization. These are submitted to finance team for thorough analysis. Usually yung mga department, iba't ibang department ng mga kumpanya, may mga proposal yan. So, nagsasubmit sila ng kanilang proposal at sinasubmit sa finance department para ito namang finance department ay i-analyze nila. Pangalawa, review and analysis. Financial personnel perform formal review and analysis to assess the benefits and cost of the investment proposals. These personnel make use of several financial tools which they see fit in evaluating the project. This time, yung mga nasa finance department, nire-review at ina-analyze na nila yung proposals in-submit ng bawat department. At dito nga, gumagamit sila ng mga tools para sa pag-a-analyze at pag-evaluate. Pangatlo, decision making. Companies usually delegate capital expenditure decisions on the basis of value limits. The analysis is presented to the proper approving body who will in turn make the decision whether to push through with the project or not. Decision making na yan. Pangapat, implementation. Kapag na-approve na yan, ready nang i-release ang funds and start of the project occurs after approval. Large expenditures are usually released in phases. Ibig sabihin, parang utay-utay. No? Hindi yung isang bigla ang paglalabas ng pera. So, phase by phase yan. Monitoring. results are monitored and actual costs and the benefits are compared with those that were expected. Pinaparallel nila yan. Ito ba yung ini-expect? Ito yung nangyayari ngayon? Ito ba yung ini-expect natin mangyayari? Action may be required if deviations from the plan are significant in nature. So, yung review and analysis, ang sabi nga natin, gumagamit sila dito ng mga tools para ma-evaluate yung project proposal. At ito yung ating pagtutuunan natin ng pansin ngayon. So, basic terminologies related to capital budgeting. First one is independent versus mutually exclusive investments. Pag sinabi natin independent, these are those whose cash flows are independent of one another. The acceptance of one project does not eliminate the others from further consideration. Mutual exclusive projects, on the other hand, are projects which serve the same function and therefore compete with one another. The acceptance of one eliminates all other proposals that serve a similar function from further consideration. Ibig sabihin, independent ay kahit napili na natin yung isang project proposal, yung ibang project proposal ay pwede pa rin nating piliin or ikonsidera. Yun namang mutual exclusive investment, mamimili ka na talaga. Kapag may pinili kang isang project proposal, yung ibang projects ay ilalaglag mo na. Pangalawa, unlimited fund versus capital rationing. The amount and availability of funds affects the company's decision in capital outlays. If the company has unlimited funds, then all projects which pass the risk-return criteria will be accepted and implemented. Ito ay kung unlimited yung funds mo. So kahit magre-risk ka dyan, basta't pumasa sa iyong criteria, pwede siyang i-implement. Otherwise, firms will operate under capital rationing and will accept only projects which provide the best opportunity to increase shareholder wealth. So sa capital rationing, since mababa ang iyong or maliit ang iyong kapital para dyan, pipiliin mo lang yung the best na proposal. Yung the best na makakapagbigay ng opportunity para kumita ang mga mangyayari ng kumpanya or yung kumpanya mismo. Pangatlo, accept-reject versus ranking approaches. The accept-reject is usually done for mutually exclusive projects where one project is favored over the others. The approach accepts project which pass a certain criterion. So dito, pipiliin mo lang talaga yung project na nakapasa doon sa sinasabi nating criteria na inilatag ng management. Ranking is done when there are several projects passing the criteria and the company is only able to fund so much. The highest ranking projects will be selected for implementation. So dito naman, ranking, marami ang nakapasa ayon sa criteria ng management, pero pipiliin lang nila dito yung highest, diba? The highest ranking project. Yun lang yung pipiliin ng kumpanya para i-implement. So we have different techniques in capital budgeting. Relevant cash flows include in the initial investment, cash inflows from income from the project, and the expected terminal value of the project, if any. These are the cash flows considered in analyzing whether an investment adds due. These are the cash flows considered in analyzing whether an investment adds value to the firm. Cash flows should be net of tax. For example, Mr. Alfonso is deciding on which of the two mutually exclusive projects he should accept. Project A requires an initial outlay of 72,000 pesos and is expected to receive 17,000 pesos annually for the next 5 years. Project B, on the other hand, requires an investment of 80,000 but will earn 21,000 annually for the next 5 years. In this example, we can see that the relevant cash flows are the upfront investment and the annual income from investment. So, may project A at may project B. Ano dito ang the best kung mamimili sila sa dalawa? So, dito gagamit tayo ng techniques o yung tools na sinasabi natin kanina. So, dito sa illustration, pinapakita yung project A, 72,000 ang cash outlay mo dyan. Pero, for the next 5 years, mag-earn siya ng 17,000 kada year. Yung sa project B naman, 80,000 ang outlay, pero 21,000 kada taon ang ma-earn niya for 5 years. So, yung unang technique ay ang payback method. This is the simplest method used in capital budgeting. It measures the amount of time, usually in years, to recover the initial investment. Tandaan nyo, it measures the amount of time. Kailan natin marirealize na bumalik na sa atin yung initial investment. To illustrate this method, let us use the previous examples for relevant cash flows. For project A, the initial cash flow is 72,000. In 4 years, Mr. Alfonso would have generated total cash flow of 68,000. To get the actual time period, let us divide the remaining amount, yung 4,000, and divide it by the cash flow for year 5. Paano nakuha yun? 4,000 divided by 17,000. So, we get 0.24. So, the total payback period for project A is, yun nga, 4 plus 0.24 is equals to 4.24 years. So, ganun siya katagal bago ma-recover yung initial investment or mabawi. Conversely, if the cash flows are equal, you may derive the answer by dividing the initial cash flow by the annuity. 72,000 divided by 17. So, ang sagot is, ganun pa rin, 4.24 years. Yun ay kung equal ang cash flows bawat taon. Using the method for project B, we get the payback period of 80,000 over 21,000 is equals to 3.81 years. Ibig sabihin, si project B, balikan natin si project B, yung project B ay mas mabilis nilang mababawi ang 80,000 kesa kay project A kasi ito ay aabot ng 4.24 years. Si project B naman ay aabotin lang ng 3.81 years. Let us also illustrate an example of computing the payback period of uneven cash flows. Ibig sabihin, iba-iba yung pera, yung amount ng pera. Initial investment, 15,000. Year 1, 7. Year 2, 4. Year 3, 6,000. Year 4, 3,000. For years 1 and 2, we have already recovered 11,000 of our investment. We need 4,000 more to each 15,000. So, for the third year, we have 4,000 over 6,000 or 0.67. The payback period is 2.67 years. Notice that the cash flow for year 4 is already ignored. The second technique, net present value or NPV. This method is more sophisticated than the payback method since it considers the time value of money and it considers all the cash flows during the life of the project, including the terminal value. The NPV can be computed by comparing the present value of cash inflows against the present value of cash outflows. Cash flows are discounted using the firm's cost of capital or the cost of acquiring funding needs to get the present values. So, NPV is equals to present value of cash inflows minus yung present value ng cash outflow. If the net present value of a project is 0 or positive, it should be accepted. In finance, if these projected cash flows are realized, the NPV of the project should be equivalent to the increase in total shareholders value. Assuming that the amount cost of capital is 8%, let us compute the NPV for our previous example. The project A equals 70,000 times mo yung PVA o yung present value, which is 3,993 lang. And then minus 72,000 is equals to 67,881 minus mo yung 17,2,000 is equals to negative 4,119. Si Project B naman, 21,000 tapos PVA niya 3,993, i-minus mo si 80,000. 83,853 minus 80,000 is equals to positive 3,853. So we can see the Project A's NPV is negative and the Project B's net present value is positive. So we only accept Project B. The third technique is the internal rate of return. The IRR is one of the most widely used technique in capital budgeting. It is defined as the discount rate that equates the NPV of an investment to zero. If this method is used for capital budgeting analysis, the project's IRR is compared to the company's cost of capital. If the IRR is greater than the cost of capital, the project should be accepted. Otherwise, it should be rejected. Manual computation of the IRR involves trial and error. However, this IRR computation is a lot easier using applications like Microsoft Excel. So example, you are planning to build a branch for your business at 350,000 pesos and expect to receive 400,000 in year 1. First, compute the rate of return or the profit over investment. So rate of return niya is equals to 50,000 divided by 350,000 is equals to 14.3%. We compute for the rate of return because the NPV of a project with cost of capital equal to the rate of return is equal to 0. So to illustrate, NPV is equals to 400,000 i-divide mo doon sa close open parenthesis. So 1 plus 0.143. Close parenthesis, then minus 350,000, that is equals to 0. The IRR can easily be computed using Microsoft Excel using the IRR function. So ganyan yung kanyang computation sa rate of return at saka dun sa net present value. The NPV and IRR are interrelated techniques. An IRR greater than the cost equates to a positive NPV and vice versa. On a purely theoretical view, NPV is the better measure since it measures the actual cash value a project creates for shareholders. However, IRR is also widely used tool since financial managers usually like to think in terms of ratios and percentages. So kagaya nito. So those are the techniques for capital expenditure analysis and evaluation. Now, let us tackle about the risk-return trade-off. Risk and return are two parameters for selecting investment in the finance world. Risk is the possibility of loss or harm, while return is the appreciation or gain or depreciation or loss in the value of the asset. So risk-return trade-off is a concept that the level of return to be earned from an investment should increase as the level of risk increases. So kagaya nung nakita nyo sa graph kanina, no? Habang tumataas yung risk, tumataas din naman yung chance na mas malaki ang kitain mo. On the other hand, kapag naman mas mababa yung risk, mas mababa rin yung chance na kumita ng malaki or ibig sabihin, mas mababa rin yung kikitain niya. Yung mga investors, ang gusto nila ay yung low risk. Doon lang sila sa low risk level. So, they tend to invest for high-grade corporate or government bonds. Yan. Sigurado kasi yan, kapag ka bonds, tapos government pa, o sa corporate pa, sure yan. Low risk level yan. Different investors will have different tolerances for the level of risk they will be willing to accept. So that some will readily invest in low return investments because there is a low risk of losing investment. Yung iba, mas mababa ang pwede nilang kitain dyan, pero dahil low risk naman siya, yan ang pinapatulan nila. Ibig sabihin, dyan sila nag-i-invest kasi tuloy-tuloy pa rin naman ang kita dyan. Others have a higher risk tolerance and so will buy riskier investment in pursuit of a higher return despite the risk of losing their investment. Yung iba naman daw, dahil may pera sila, nagre-risk sila na ang kuhanin nila yung may mas mataas na return. Kahit na may possibility o malaki yung possibility na mawala yung kanilang ininvest. Diba? Yung matalo sila. So, ganyan lang talaga. Ang bawat investor may mga subjective analysis pa rin yan. No? Kahit na heto, naintindihan na natin ang pagkakaiba nung higher risk sa lower risk pagdating dun sa kitaan, may mga point of view pa rin naman sila na kanilang pinaninindigan. In making investment decisions, financial managers take note of the risk and returns they are entering. So let us recall the story of Jack and the Beanstalk. Diba sa story, nakipag-trade si Jack doon sa cow niya, doon sa 3 magic beans. Ang ginawa niya ay very risky. Bakit very risky? Kasi, ang sabi nung stranger, ito ay magical beans. At malaki ang chance ng opportunity mo dito sa beans na ito. Pero, since hindi tayo sigurado kung totoo ang sinasabi nung stranger na yon, ito na yung sinasabi nating risky ang naging move or decision ni Jack. Ngayon, kung alam niyang totoo yung sinasabi ng stranger, o di isang malaking chance to or opportunity para sa kanya, para, di ba, mag-go beyond yung kanyang dreams. So, ano ang nangyari doon sa transaction? So, should Jack decide not to sell the cow for magic beans and instead sold it at the current market value, the story would be different. Kung si Jack ay, binenta niya lang yung kanyang cow at hindi niya pinutulan yung sa offer ng stranger, kumain sila sa araw na yon, kumita sila sa araw na yon, kaya lang yung malaking opportunity wala. As we can see, the higher the risk, the higher the returns. But of course, if it turns sour, the higher the losses as well. Kung yung stranger pala na yun ay isang scammer at manloloko, itong high risk na pinasok ni Jack ay magiging yung sour na tinatawag, di ba, napakasakit na mangyari yon. Kagaya ng mga nangyayari sa ngayon, guys, sa mga bali-balita, no? May mga ino-offer na mga investment na ang laki ng opportunity na pwedeng kitain, pero alam natin na napakalaki ng risk ng mga yon. So mamaya, babalikan natin yon. Ways on how the risk and return trade-off can be applied in real life. Sa totoong buhay, paano natin na-apply yung risk and return trade-off? These are the examples. Fixed income versus commission-based income. Ano ang risk dyan? Kung mamimili ka sa dalawa, anong pipiliin mo? Fixed income ba or commission-based income? Pagka fixed income, mababa yan kesa doon sa pwede mong makuha sa commission, pero ito, stable yan. Permanenteng kikita ka buwan-buwan sa ganyang amount. Pagka naman commission-based, may chance na ikaw ay kumita ng mas malaki kung ikaw ay makakabenta ng mas malaki. Gayunman, kung pwedeng wala ka ring kitain or mas maliit ang commission mo kung maliit lang din ang iyong may bebenta. So, yan ang magiging pagkakaiba ng fixed income versus commission-based income. Pangalawa, earning interest from the time deposit versus earning from stocks. Kapag nagpasok ka ng pera sa bangko, time deposit, ang sabihin natin ang iyong kikitain dyan ay mga 4 or 5%. After, siguro mga ilang buwan or taon, time deposit kasi yan. Whereas, kung ikaw naman ay i-invest sa stocks, ang risk mo dito ay pwedeng hindi ka kumita kasi stocks yan. Kapag mababa ang performance ng company, ang dividend mo ay maliit din or pwedeng wala. Pero kung ang performance ng company ay maganda, profitable sila, ang iyong kita mula sa iyong stocks or yung tinatawag nating dividend ay mas mataas din. Yan yung from the stocks. Pero itong paglalagak mo ng yung pera sa time deposit, sigurado na may kita ka dyan ayon doon sa percent na in-offer sa'yo. Hindi mawawala yon. Pero one time lang yon. At hindi na siya pwedeng tumaas pa. Pangatlo, entering in a business with steady income versus entering into a seasonal high-profit business. Ito yung ang negosyo mo ay tuloy-tuloy, steady income. So kahit hindi season, nandyan yung negosyo mo, yan, kumikita ka. Steady yon, permanent. Or, mag-engage ka na lang doon sa seasonal businesses na tinatawag natin. Halimbawa, yung mga business na papatok kapag magpapasko, o kaya yung mga business na papatok kapag summer. Dahil kapag nag-start ka ng business sa mga ganyang season, kikita ka. Kaya lang, hindi steady. After that season, wala ka ng earnings from your business or mas mababa na lang. So, yan yung sa dalawa, no? Steady income versus doon sa seasonal income from seasonal businesses. Pangapat, investing in preferred or common stock. Alam naman natin na pag preferred stock, ikaw ay preferred. Una kang bibigyan ng dividend kesa doon sa common stock. Pero kung pag-uusapan natin magkano, gaano kalaki, fix yung iyong pwedeng kitain mula doon sa iyong preferred stock. Unlike doon sa common stock, pwedeng bumagsak ang presyo or yung profit mo or yung dividend, pwede ring mas mataas ang iyong dividend. Depende sa performance ng company. So, yun yung sa common stock. Ang maganda lang sa preferred stock is fix ka na may matatanggap. Sigurado yon. At sigurado rin doon sa porsyento na in-offer sa'yo noong preferred stock. So, yan yung pagkakaiba ng dalawa. Now, let's take this example para dito sa risk-return trade-off. You purchase mutual fund units worth 10,000 today and plan to withdraw your money in 3 years. Historically, mutual fund units have yielded 20% annual return. Hence, you expect your investment to grow approximately 14,050 in 3 years. So, from 10,000, magiging 14,050 siya in 3 years. Your risk here is the chance that your units will be worth less than 14,050 in 3 years from today, or the possibility that your units will be worth more. To put this in perspective, let us consider two investment options. Shares of a company, or the option A, and the bank fixed deposit, or the option B. Dalawang pamimilian mo. Invest ka sa kumpanya or i-deposit mo na lang sa bangko. So option A, shares. Ang option B ay bank fixed deposit. Ang ina-expect nating return dito sa option A, 15%. Sa option B, 7%. Mas mababa. Ang return range with 95% chance. Sa option A, 9% hanggang 21% ang chance mo na kumita na mas malaki. Pero dito sa option B, hanggang 8% ka lang. Kasi nga, fixed deposit yan. As you can see, while A has higher expected return, there is also a higher degree of uncertainty over actual returns. So your actual returns could vary between 9 and 21% with a 95% chance. In B, you are more or less assured of an earning close to the expected return of 7%. So going back to our original point, investment A is riskier investment option, hence offers a relatively higher expected return to compensate for the associated risk. While investment B is less risky investment option, hence offers a relatively lower expected return. The same is true for all kinds of investment. Gaya nga ng lagi nating sinasabi kanina, kapag mas mataas ang kita, mas mataas ang risk. Mas mababa ang kita, mas mababa rin ang risk. So how is risk-return trade-off important? This understanding of risk-return trade-off is very important in making correct investment decisions. Ulitin ko, correct investment decisions. It helps you pick the right investment option, bearing in mind how much risk are you willing to take. It also helps weed out fraudulent investment proposals. If someone comes to you and says that he has a proposal that will earn you a guaranteed 20% return with no risk, you should simply walk off. Nothing in life comes for free. Ang ibig sabihin niyan, guys, sa ngayon ay ang dami-daming mga nababalitaan tayo sa TV na na-scam sila dahil sa kanilang pag-i-invest. Tandaan nyo, kapag ang offer ay ang kikitain ay too good to be true, scam yan. Yung mga nag-offer na mag-i-invest sila ng certain amount tapos kikita sila ng 20 to 30% per month doon sa kanilang ininvest, yun ay scam. Ang hirap nun, guys. No? Hindi siya stable, hindi siya sustainable. Kung yung mga bangko nga, mataas na yung offer nila na 2 or 3% interest mula sa deposit nila or sa savings deposit, tapos itong mga naglipa na sa kalsada na nag-o-offer ng 20-30% nakikitain monthly monthly. Paano nila maibibigay yun sa mga tao ng tuloy-tuloy? Hindi na sustainable. Tapos ang mga bangko maibibigay lang nila is 1, 2, 3% annually pa. Hindi siya monthly. Kaya guys, no? Pag ang sinasabi natin, if it's too good to be true, scam na. Mas mabuti pa guys kung kayo ay mag-i-invest kesa dyan sa mga yung mga magre-recruit ka ng tao tapos kikita ka na sa recruitment. Yan. Ang tawag dyan ay pyramiding. Yan. So, risky ang investment mo dyan. Most likely, mawawala yan at pupunta kayo kay Tulfo. So, for our question of the week, Robbins Incorporated is considering a project that has the following cash flows and cost capital data. What is the project's NPV? Note that if project's expected NPV is negative, it should be rejected. So, yung cost capital natin ay 10.25%. So, year 0 hanggang 5, tapos ito yung mga cash flows na nakikita nyo. 1,000, tapos from year 1 to 5, 300 na lang. So, letter A, 111.47. Letter B, 117.33. Letter C, 123.51. And letter D, 130.01. Comment your answers on the comment section. So guys, nandito na lang ating lesson. See you again next week for our next lesson. Have a nice day.